Okay, everybody, let us begin. My name's Justin, Business Development Manager here at Fullerton Markets, bringing to you a special class on oil and how we can trade it profitably. All right, so before we begin, a lot of people are joining us in this class, and some of you have probably seen other forex traders out there who share some of their trades regarding WTI oil on their MT4s, and you might be wondering, is this something that I can trade too? The short answer is yes, you can. As clients of Fullerton Markets, you can trade oil here on our platform just as easily as if you were to trade forex or other precious metals. All right. So today, just sit back and join me as we talk about oil and how you guys can trade it profitably and add it to your portfolio. So let's begin. All right. So when we talk about oil, we see these terms WTI and Brent. All right. What does WTI stand for? Basically, it stands for West Texas Intermediate. Now, these are oil that is generally extracted from the oil fields in the US, such as Louisiana, North Dakota, and Texas. All right. Another type of oil that you guys might come across would be Brent. All right. Now, these come from the North Sea. All right. There's Brent, Forties, Osberg, and Ecofisk BFOE. All right, so there are a few differences between WTI and Brent with regards to the actual oil itself. WTI is considered very light and sweet. Brent is considered light and sweet, but as not as much as WTI. API gravity of 39.6, the other one is 38. The sulfur content in their oil is 0.24%, while there is more sulfur in Brent, all right? WTI, since it is mainly extracted from the mainland US, it has to go through land, all right? While Brent is actually extracted from the sea, all right? So if you see those movies where there are oil rigs out in the ocean, and then that's where we get the oil from Brent from. All right. So comparing the two, it's much easier to transport Brent since it's already in the ocean and they can just easily deliver it wherever they need to deliver it to. All right. So let's move on. Now there are a few differences when you're trading crude oil. All right. There are a few differences. First off, all right, brokers out there do offer oil. All right. A lot of brokers offer you the option to trade oil, but it's how they price it. It's how they offer it to you that makes it different. Some brokers out there offer it as a CFD. Others offer it as a futures contract. Okay. All right. Let's just keep that in mind. But let me just go through what are some of the differences, right? When you're trading CFDs or contracts for differences, right? You don't need as much capital as if you were trading futures contracts. All right. The liquidity for CFDs are actually quite high, futures very low. There are no restrictions on CFDs. In fact, it's actually really flexible in the way that you can trade CFDs more than futures. All right. Futures, basically, you buy a contract, let's say today, and then it will expire in a month, 2 months, 6 months, a year. And whether or not you profit, it will close out after the period ends, all right? So they are restricted by expiry dates, all right? That's why they're called futures contracts, all right? Can you trade CFDs with leverage? The answer is yes. Can you do that with futures? The answer is no. This is also another reason why it says there are high capital requirements, okay? If you do not leverage, you need to pay for the entire, let's say the entire contract, all right? With leverage, we can actually trade the same amount with using much less money or much less capital. That's why it is not as capital intensive. Now, this is very important for you to know as a trader, all right? So let's move on to the next slide, all right? So earlier we had the futures, right? We were talking about futures and CFDs, all right? Futures-based pricing, basically what happens is there is no fixed price. All right, the price, you will only know the price once it expires. All right, unlike spot pricing. All right, spot pricing, it's also the same as CFDs. Basically, what happens is they are giving you the price right now. Okay, so if you're trading, let's say you're trading on two brokers, one of them is offering you spot pricing, the other one is offering you futures-based pricing. All right, the futures-based pricing will continue while spot pricing will give you the price right now and you can close it right now. Okay, fortunately, Fullerton Markets uses spot pricing. All right, when we when we offer oil to our clients. All right. And, you know, if you guys have traded with other brokers, sometimes we have different symbols. All right. The reason why there are different symbols, for example, one could just say US oil, the other one can say WTI USD. The main reason has to do with the liquidity providers that we use. You know, they might quote it in a different way or they might use different symbols. All right. So it's very important for you to know what type your broker is using. Okay. Here at Fullerton Markets, we are using spot pricing, so we get the latest prices. All right, let's move on. So here are a few things that we have to take note of. All right. All right, we have WTI oil for the first column. The second column is WTI oil M for mini, meaning these are smaller CFDs. And the last one is Forex. All right, just to give you guys a little differentiation. All right. The contract size is roughly 100 units, all right, for both WTI oil and mini. While for Forex, it's 100,000 base units of the currency, all right? Now, the main difference between WTI oil and the mini is the lot size, the minimum lot size that you can open, okay? For the regular WTI oil, it's minimum of 1 lot, while here with the mini, we can open 0.10 lots, all right? And of course, Forex is the lowest where they go as low as 0.01, all right? What is the maximum that you can trade? You can trade 250 lots for both oils, and for Forex, that is 100 lots per trade, okay? Leverage, once again, it depends on your account type. All right. So these are the main differences when you trade oil versus Forex. All right. But fear not, since, you know, they might be different, right? You are still trading on one platform, MetaTrader 4. All right. Everything is there. And later on, I will be opening my chart to show you guys how you can actually access oil. All right, just in case some of you are not sure of how you can actually trade it. Okay, let's move on. Okay, so this was from earlier. WTI USD or oil is equivalent to 100 barrels. All right, margin currency, it is in the US dollars. Tick size, it refers to the minimum number of movements in price. Here it's 3 decimal points. And what is the pip value per lot? All right, is approximately 1. So for every 1 pip movement in the price of oil at 1 lot, you get 1 USD. Okay, that is it. Let's move on. All right, so there are 4 factors basically that affect oil price. All right, now this is very important because as traders, we have the technical analysis, all right? A lot of traders focus on the technical analysis, while it is also very important for you and I to know both fundamental trading techniques and technical trading techniques, all right? So when it comes to the fundamentals, all right, we're gonna talk about, we're gonna dive deeper into that and talk about what are some of the factors that affect oil price. With the first being the OPEC. All right, what does OPEC mean? What does OPEC stand for? Basically, OPEC is the organization of the petroleum exporting countries. All right, so they are the organization. It was first started somewhere around September of 1960 with only 5 countries, namely Iran, Iraq, Kuwait, Saudi Arabia, and Venezuela. All right, so these 5 countries way back in 1960 got together and said, hey, we need to come up with the standard for oil. all right? So they did just that and they started the OPEC. Today, there are quite a lot more countries that have joined OPEC, all right? All of these countries also export oil, all right? That's one of the requirements to be a part of the OPEC, all right? So they are one of the factors, all right? To give you guys an idea of what they are, just imagine in your country, all right? In your country, there might be numerous banks, all right? But they all still listen to the central bank, correct? You guys might have insurance companies, they still listen to the insurance commissions, all right? And there are government bodies out there that are managing other industries. The same is with the oil industry. We have the OPEC, and that's what they do, all right? That's the first factor. The second factor would be supply and demand of oil, all right? Later, you will see this in action, all right? The third is geopolitical events, all right? And lastly, we have natural disasters. So let's first tackle a few things, all right? This is OPEC, all right? Let me read to you the article. It says, oil plunges 24% for worst day since 1991, meaning currently at this date of April 6, 2020, we are seeing the lowest, we are seeing the worst plunge since 1991, all right? Prices dropped by 24%. It hits the multi-year low after OPEC deal failure sparks price war, all right? All right, people were anticipating an OPEC deal. However, it failed and now there's a price war, which drove prices lower, all right? I will show you guys on the MT4 charts later when this exactly happened, all right? After that, we have demand and supply. Oil ends on a low after halving its in 2014 as OPEC stands aside, all right? Oil prices fell on Wednesday to a 5.5-year low and ended with their second biggest annual decline ever, down by half since June under pressure from a global glut of crude, all right? Now, what does this mean? It means that there is an overabundance or an oversupply of oil in the world, all right? This has to do with, with shale oil. And because there's too much oil in the market, prices of oil dropped, all right? This was way back in 2014, all right? I'm sure a lot of you were at this point were aware of this. You might have felt that gas was particularly cheaper around then, all right? So yeah, this is an example of supply and demand. More oil in the market led to less demand and prices dropped consequently, all right? Next would be geopolitical events, all right? Oil prices rise as Libyan conflict intensifies, all right? Oil prices have moved closer to recent highs as conflict in Libya intensified, all right? Brent crude futures rose $2.40 to almost $118 a barrel before falling back below to 116.5, while US light sweet crude rose $2.75 to $102, all right? Geopolitical events, it affects a lot of things. Basically, this could lead to, for example, less oil being mined or less oil being circulated simply because there is conflict in Libya, all right? And if there is less oil out there in the market, prices will climb up, all right? So that's an example of a geopolitical event. Next would be natural disasters. Coronavirus, oil price collapses to lowest level for 18 years. I'm sure, and in the beginning of the coronavirus, there were a lot of lockdowns, correct? Lots of people were not going out. People were advised to stay at home. People were not driving their cars as much. People were not. Simple, because where else would you go? You didn't want to catch the virus. You probably had gas in the tank for a month and you didn't even use it. This also led to the global demand of oil to drop, all right? Leading prices of oil to drop as well. Currently, you guys know what the current price of gas is and how coronavirus affected oil. You guys were also a witness to that. So, you know, these are the four factors that generally, the four fundamental factors that affect the prices of oil. All right, let's move on. Today, I'll be sharing with you guys 3 tips so that you can trade oil profitably. All right. The first has to do with risk sentiment. All right. First has to do with risk sentiment. When risk is on, the prices of oil go up. When risk is off, the prices of oil go down. All right. Now, how do we use this? Basically, what you have to do is you have to take a look at a few things. All right. You have to take a look at the first 3 things that you're going to have to look at would be the Australian dollar, the New Zealand dollar, and the Canadian dollar. All right. Look to these to determine if it is risk on. Okay. If you want to know if it is risk off, you would have to look at the gold and the yen. All right. You have to look at the gold and the yen. All right. Once you know what the risk sentiment is, you can then go back to oil and you now have your bias. Right. Now couple this with perhaps some trading strategies and you can trade oil profitably. All right. So that's the first tip. All right, let's move on. Now, the second tip has to do with OPEC future plans. All right. Once again, OPEC stands for the Organization of the Petroleum Exporting Countries. All right. Basically, OPEC, they meet quarterly. All right. They meet quarterly. OPEC meets quarterly to inform the world of what their plans are. All right. They plan to restrict supply of oil to keep prices, you know, to deal with the price, or will they be easing supply, pumping more supply into the world, effectively bringing the prices of oil up or down? All right. Now, this information is widely followed, and you know, if you guys are using some Forex calendars, this information is also available there. You can easily Google it and, you know, find out what the future plans are. They meet every quarter. All right. So that's every 3 months. Okay. So that's the second tip. All right. If they say they restrict supply, prices of oil will go up. If they say they are easing supply, meaning more will be flooding into the market, the prices of oil will go down. Simple supply and demand. All right. When they restrict supply, there is less oil, drives up the demand, drives up prices. When they're pumping more oil into the market, the demand also grows. The demand lessens, and that will also bring down the prices of oil. All right. So that's a second tip that you guys can take note of. The third tip has to do with global interest rates. All right. So when interest rates are high, oil will also go high. And when interest rates are low, prices of oil will go down. Why is this? Well, let's take a look at why would a country lower its interest rates, right? Why would there be low interest rates? Basically, when an economy is contracting, all right, when an economy is contracting, it means the economy is not doing well. Interest rates are lower, and they want people to start. They want people to start and make use of the low interest rate to take out loans, so that more money will be moving in the economy. This means that the economy itself is not doing so well. All right. When it's not doing so well, the demand for oil also takes a hit. All right. So when the economy is bad, it's also bad for oil. All right. But when it is great, when interest rates are high, oil will also climb higher. All right. So, ladies and gentlemen, that is it for me. My name is Justin, Business Development Manager here at Fullerton Markets. I hope you guys enjoyed our class, and I look forward to seeing you all in our other classes. Thank you all, and goodbye.